Good morning, America. Thank you for tuning in to Taxes Made Easy. Thank you for those that are watching live or on rebroadcast. And again, we've focused a lot on the offer and compromise. It's what most people have a lot of questions about. So we spent a lot of time walking through that. And today, I want to address another question that's big on people's mind. Penalties and interest. A lot of people say when they owe taxes, it feels like it's like quicksand. They pay, and their money is just getting thrown away, and they never feel like they get anywhere. We're going to talk about why they feel that way and how to avoid that, how to avoid all these nasty penalties and interest from the IRS. So again, we'll be back after a short commercial break and walk through what are the penalties and interest the IRS charges and how to avoid them. So again, Hubert Johnson with Taxes Made Easy. Welcome back, everybody. So again, Taxes Made Easy, and today we're going to focus on the fun topics of penalties and interest. The main reason I want to focus on this is because it does so much damage to taxpayers. It hurts them so bad, and most people, they don't even understand what's going on. So I've kind of talked on this before, but we're going to talk about kind of go into this in more detail. And we're going to talk about some changes the IRS has made, not for the better, especially this last year. So the IRS issues penalties to try to get taxpayers to follow their rules, follow the regulations, again, to charge normal interest when you owe a tax debt or any kind of debt. Interest is charged, but again, it can be absolutely outrageous because Congress has allowed the IRS to layer on penalty after penalty, and they just allowed Congress to just allow the IRS to increase one penalty from 1% to 2% to 8%, a huge jump. And again, it's going to just pull more money out of taxpayers' pockets. And it's not like the federal government doesn't get enough, but again, they can never spend enough. So that's where the money just goes right out the door. So first, talk about the basics. We're going to start off with the very basic part. When you file your tax returns, you want to do it correctly. You want to make sure you have all your information. If you're missing anything, file an extension, pull transcripts from the IRS, and make sure it's done correctly. If you do file your tax return and you find, oops, I missed something, go and amend it before the IRS files it. So hiding stuff from the IRS, putting on blinders and hoping they don't find it is what a lot of people do. In most cases, the IRS has more information than we do, especially even as tax attorneys. The IRS has tons of information at their disposal. So if you get issued a 1099, a W-2, any kind of mortgage interest, and you're not reporting income, that's easy. That's a low-hanging fruit that the IRS can easily go and say, okay, you didn't report this. Their computer systems are just grabbing that stuff automatically and hitting you with underreporter penalties and fees. If you go through an audit, the penalties and fees are nasty. So not only can they come up with a tax debt, but the penalties and fees for underreporting, not reporting, are pretty nasty. And if it's bad enough, you can be charged with willful evasion of taxes, which becomes a criminal issue. That is very rare. Normally, the IRS goes in and they do their assessments, they do their investigation, but a lot of times this is just done by computers. So one of the big problems I'm seeing more time and time again is that the IRS computer systems, it's easy for them to just run through and grab these returns, these reports that are submitted to them. They all show up on your wage and income. but make sure that information is correct. A lot of issues coming out with um, misreported or incorrect W-2s and 1099s. So employers are getting lazy. Sometimes they issue a 1099 incorrectly. You have to contest that. If it's not done correctly, you can claim it. Your identity has been claimed or has been stolen. If someone's filing 1099 information and it's not your social, and all of a sudden your taxes have been increased, you need to fight that. You need to contest that. Putting the blinders on and ignoring IRS audits is a huge problem. Examinations, the same thing. If the IRS comes in and says, "Hey, we think you should be, have an audit or examination," don't ignore it. This is your chance to get in there, get a bite at the apple, contest it, and there's plenty of times where the IRS does this, and you can fight it. You can win. There are plenty of times people come out of an IRS audit and don't owe anything. Now, the problem is you never come out completely unscathed because it takes you the time, the money. If it's anywhere complicated, you don't know how to handle it, you have to hire a tax professional to handle it. Most CPAs can handle an audit, no problem. If it comes to the point where it's really complicated or there's a lot of negotiation required, that's where you might want a tax attorney to go in, where it's more of a negotiation, and again, or you have to go to appeals. So don't hesitate to call, get second opinions, talk to an attorney, talk to a CPA, and a good attorney, if they say, look, this is something simple, they'll refer you to a good CPA. That's what we try to do if it's something that doesn't need our level of expertise. If you get something that seems like he wants to hire for anything, be aware, be cautious, or be wary. So that's the first way that you can get hit with penalties and interest is the audit examination and underreporting things, where the IRS looks at your tax return and says, hey, this is incorrect. The next way that the IRS can come and hit you with a lot of interest and penalties. So when they do that, when they assess this new balance to you, there are a lot of penalties that go with that under an audit examination. So under reporting, interest for when the tax return was filed. So was filed or should have been filed. So this interest goes backwards depending on how old the tax return is. The older the tax return, the more interest you get hit with. Failure to pay timely is another one. And again, we're going to break this down, but first I just want to talk about what events cause this. So the next one that cause tax debt is what's called a substitute for return. Essentially, when the IRS finds out you haven't been filing taxes and they've gotten information that says you should have been filing taxes, they will go in and file for you. There's no deductions. They file single and zero for you. And it's done in the worst way possible for you. So again, you go in, and when the IRS files for you, you can replace that with the original return. But you have to go through and you have to fight it. Now you have to dig up all that information. The states are much worse than the IRS when it comes to filing returns for you. They call it filing enforcements in more states, or they use the IRS term substitute for return. There are some states, California is the worst, but there's other states following in California's footsteps. They will assume that you had income if you had a license, if you had prior income and you just stopped working. So I've seen people go to jail and have filing enforcements filed against them. People that stopped working, they became unemployed, and they didn't file a return that year because they didn't have a filing requirement. You didn't have a legal reason to file, but the state still goes and files for you. Again, it's a gray area that they exploit to no end. And when they do these filing enforcements, trust me, they tack on the penalties and interest. And then when you normally owe taxes, so whether you file your tax return and you don't, it's not paid in full, you don't have enough withholdings to cover the whole amount, that definitely hurts you when it comes to penalties and interest. So let's talk about the different penalties and interest. We talked about the underreporting. There are penalties when you take out money out of a 401k or any kind of a 401k, IRA, or any other kind of government set up plan that encourages you to hold on to this money until retirement. Problem is, people like to take money out of 401ks. The best way to do that is to borrow against it. It's not a taxable event, but then repay it and pay yourself back. You're paying interest on your own money as you pay the loan back, but if you take it out, you're going to get hit with 20 to 30% and penalties for that year. And I say 30% because often it puts you up in the next tax bracket. And when you take out a lump sum like that, all of a sudden you're paying a lot more in taxes. So it hurts you in multiple ways when you take money out of retirement accounts that are set up, that are set up by law. Now, when you cash out other retirement accounts, make sure you have sufficient taxes withheld. If you want to purchase a home, if you're doing this. And a big thing that I see people make a lot of mistakes with are self-directed IRAs. You can do it. Make sure you have a professional guiding you. Make sure you have someone helping you. If you want to invest to a friend or something like that, but you want to keep the money in an IRA, fine, you can do that. But there's plenty of people that get burned. And here's the worst part about that if you do get burned and you lose your money on a bad investment, you need to go and report that to whoever is reporting, managing your IRA. Because if you don't, they'll treat it like a taxable event and they will tax you. You will get taxed on the full amount that you had in your self-directed IRA and lost. So you lost the money. Not only do you lose the money, but the company is going to cover themselves and report it as a gain to the IRS. And I've seen this plenty of times. So make sure when you're making these moves in a self-directed IRA that you are in communication with the company that is initially handling the IRA. And if you lose funds, make sure that's communicated clearly to them. And if they issue a 1099, you need to contest that right away. If they issue a 1099 for the full amount of the loss or what was in the self-directed IRA, because that is a huge tax blow. Not only do you lose the money, then you get taxed on the money you lost, which, again, be careful. Make sure you get advice going through the process and that's communicated. So we're going to take a quick break here. And when we come back, we're going to talk about the penalties and interest that get assessed on every case when you owe taxes. Again, we'll be back in just a couple minutes. Hubert Johnson with Guardian Tax Law. Hubert Johnson here back again with Taxes Made Easy. Again, if you have any questions, you can reach us through our website, Guardian Tax Law, or our phone number, 520-485-7371. We provide free consultations and again, we help people all the time that call in, have a couple questions. We don't feel like you should get charged an arm and a leg just to get steered in the right direction when it comes to tax debt. So number one penalty, and this is the nastiest penalty out there, failure to file timely. So if you don't file your tax returns timely, what's the penalty for that? 4.5% a month. Then it caps out at 25%. So when you go in there and you file your taxes, if you don't file by April 15th, it starts running from that day. So when you do file your tax returns, they'll assess this penalty going all the way back to when you should have filed your tax return. 4.5% every single month is a pretty nasty penalty. Now, it actually goes, if you file an extension, It won't start until you go past the extension date. And then they'll calculate it from the extension date once you do file it, or they file a substitute for return for you. Then they'll calculate that back. And when you file an original return, then they'll add that, that'll be added. So this is one of the easiest penalties to avoid, is just filing timely. And filing timely, make sure that you're filing compliant. If you're not filing compliant, the IRS is just going to continue to hammer you. I have cases where people owe hundreds of thousands, if not millions of dollars, and they're still struggling to get filing compliant. It's the number one thing you have to do is file your taxes timely. And there's a good portion of our population that struggles with that. So once you get in the habit of filing timely, moving forward, you don't want to deal with the IRS. You want to get rid of them. You don't want them hounding you and coming after you. And trust me, there's plenty of people when they fly under the radar for years, but when the IRS gets a hold of them, it's no fun. It's stressful. It's not worth it. Absolutely not worth it. So you get that's your first nasty penalty is the 4.5%. And let's pile on top of that. The next worst penalty is failure to pay timely. Now, even if you file an extension, so a lot of people that file an extension, they have businesses that takes longer for them to get this done, or they just didn't get their taxes done by April 15th. It's harder and harder to find a good CPA. The CPAs fill up. And so a lot of times the CPAs, if you get to them too late, they'll just file an extension and get your taxes done by October 15th. So if they file your taxes by October 15th, you won't get hit with the failure to file penalty as long as you have an extension, a valid extension filed. And that's easy to do. But let's say you pay in October when you file your taxes. Are you going to get hit with this penalty? The answer is yes. Because the due date to pay is still April 15th or whatever the tax day is for that year, if April 15th falls on a weekend. So you still have to pay by April 15th or you get hit with this penalty. Now, how bad is this penalty? So it starts off slow. Initially, it's 5%. If your case goes to a collection status, it's 5% a month. Then it jumps up to 1% a month. So not nearly as bad as the fail to file, but it accrues and continues to accrue until it hits 25%. Sound familiar? So the longer you wait to pay and the longer the tax debt goes, that penalty continues to accrue every single month. After a year, it's at 12%. 2 years, you've pretty much maxed it out when you're in a collection status. Now, what happens when you go into an installment agreement or a non-collectible status? You go in and you set up an arrangement. Then it continues to accrue, but it goes down to 0.25%. So it pays to engage the IRS to go ahead and get this resolved, and that reduces how much or how quickly these penalties and interest accrue. So we're talking about these are all penalties right now. Failure to file, penalty, failure to file timely, failure to pay timely. So these are all penalties that you can get or attempt to get abated as well. We're going to talk about towards the end. So a lot of people ask, how can we get these removed? Now, while you can often get penalties abated or removed with the IRS, it is much harder to do with the states. A lot of states just don't do it. New York really doesn't abate penalties. You have to do their offer compromise program. California has a horrible offer compromise program. But in most situations, most cases, they don't abate penalties and interest. They just don't. They don't see a need to. Why? And their penalties and interest are just as bad or worse than the IRS's. So here you have this failure to pay timely that accrues starts off at 0.5%. Once you go into collections, it goes up to 1%. But if you set up a resolution, it goes down to 0.25%, and it still increases every single month until the debt's either paid in full or it hits 25% of the total assessed balance. So again, that's right there. If you max out on those two penalties, 50% increase in your tax. Now, here's the fun thing that never stops: interest. Now, it used to be that interest wasn't that bad. So if you're in a collection state, they're going to come after you. They're going to your penalties will increase faster. But the interest is based on the Fed rate. Last 10, 15 years, it's been kept very, very low. So even prior to 2008, George Bush figured out that he could goose the economy and get a better economy if he artificially kept interest rates low. It led to the housing market crash. And then since then, every president since has wanted to keep interest rates low. Why? Because it helps their presidency, the economy. But by keeping it artificially low, we've had this bubble going on. So but the result of that is in the last 15 years, interest rates have been very low. Now they've doubled. So the official federal interest rate on IRS taxes and for most government debt is 8%. It used to be between 4 and 5, dipped down to 3 for a little bit, but that was typically between 4 and 5. Now it's at 8. And the question is the Fed going to increase it or not? And so that becomes an economic question. Is inflation still raging on our economy? A lot of people argue no. If you go to the grocery store, you might say absolutely. If you go to purchase a home or rent a home, the rental market is still a disaster, and you might say absolutely. So inflation at 8% gets added on, and it compounds. There's no break. There's no rest. Inflation doesn't sleep, and that kills you. The only way to get rid of inflation, again, is through some kind of abatement or paying off the debt or settling it through an offer and compromise. That's the only way to address it. So with the ongoing interest, again, you have the failure to pay penalty, failure to file penalty. Now you tack on interest on top of it. You're looking at, and that doesn't have a cap. That just keeps going and going. This is why when people have larger debts over 100,000, it keeps adding. You can call back in a month, another couple thousand is added. People are like, oh my gosh, what's going on? I can't keep up with this. Well, it's a hole you've dug, and it's a really hard hole to get out of unless you can do an offer or something like that. So again, I have one case where it's a $1.8 million debt. It's adding almost 100,000 every year. It's nuts. It's out of control. And the IRS even acknowledges it. They're like, look, you've got to make some huge down payments because this is out of control. You're never going to be able to pay this off. And so that's why we're looking at all options to help address that for him. This is a new one. So since November, our Congress authorized IRS to do this. And for self-employment taxes. So if you are self-employed or a 1099, someone is not taking taxes out of your wages as a W-2 earner. There used to be, it was 1 to 2% penalty for failing to make regular estimated tax payments. So the law is you have to make quarterly payments. The truth of the matter, most people are really bad about making quarterly payments. So you have to set this money aside every single quarter, or like a realtor, you might have a high season, low season. When you get a bunch of money, if you don't set it aside for taxes immediately, when the quarterly payment comes up, it's too much. You can't handle it. So again, you have to be disciplined and set money aside. So this is why I highly suggest that this is done On a monthly basis, you look at your receipts every single month. You make a determination, what does my income look like? And this requires you to have a good handle on your income and losses. And most small business owners, they just don't. They just, a lot of them don't even know what they're making. A lot of 1099s, they have costs. They know, it's paying their bills. A lot of times they enjoy what they're doing, which is why they're doing it. But they're not looking at the minutiae here. Do you have to look at the minutiae? The answer is no. Should you have someone looking at it for you if you're not good at that or you just don't like it? Absolutely. I can tell story after story of small businesses that have been killed by estimated tax payments. But when we go in, we help them focus on what they do best. We deal with the minutia. We get professionals behind them, and it doesn't have to cost an arm and a leg. If you feel like you're getting overcharged by a bookkeeper, CPA, etc., shop around. If you very well might have a lot of work to do. I had one case where we brought them on board and they had a lot of bookkeeping work, and we sent them to a bookkeeping company. They're very good. They're excellent. It was $10,000 to do bookkeeping going back years because it was a mess and there were hours upon hours of work. And they threw up their hands like, how can we do this? So this is the product. You can either, if you're a big enough company, maybe you hire someone full-time to stay on top of your books, or you get a bookkeeping company, and if you stay on top of it, it's so much easier. So if you're looking at this and you're saying, well, it's been years and it's a mess, start now. Go get someone moving forward to keep track of your books. And if you want to go backwards, I can help. But if you don't have good books in order, when different IRS programs come up like the ERC, a lot of people are scrambling and paying CPAs to clean things up going backwards so they can apply for these programs. The PPP loan was another thing. You had to have your books in order. Not only does it help you know what's going on with your business, but it helps you plan for it as well. So again, it helps you in many ways as a business owner to make sure you have this put together. Once you know what your business is making, you can pay regular estimate. You can make an accurate guess as to what your current income is and pay it quarterly, or you can pay it monthly. So if your numbers aren't together, or if it takes your bookkeeper too long, they're too busy, and you just don't get it quarterly, the IRS is fine as long as you paid 90% of the prior year taxes. So if you're looking at last year, what do things happen last year? Pay at least 90% of that in the current year, and you're fine with paying estimated tax payments. Because the penalty, did I mention this? It went from 1% to 2%. Now it's up to 8%. So this is something in 2024, it's going to hurt. People that are self-employed, that aren't paying estimated tax payments, they just, they pay it at the end of the year. It's going to hurt. And their tax bill is going to be much higher, and they're going to wonder why. Now, this isn't over time. This is a one-time penalty for the current year of 8%. So if you have 50,000, add $4,000 just from that alone. If you are not paying estimated tax payments throughout the year. A lot of people are just used to the ding of 1%, whatever. And it's like, whatever. I know I'm supposed to do it quarterly. I don't care. That's going to hurt. And this is how you make sure you don't have to hire a tax attorney and pay us, because you're going to stay on your taxes moving forward. I've seen plenty of large businesses where, look, you've got to pay your taxes. Pay your taxes first, death and taxes, avoid all these issues. So this 8% is added on top of everything else now. So you're looking at ongoing 8% interest plus an 8% penalty for failure to make estimated tax payments, plus the 25% for failure to pay, and another 25% for failure to file timely. This is where it gets out of control, This is where a lot of people come to me and say, look, I'll pay the original balance, but they're killing me with penalties and interest. I'm like, this is what happens when you don't deal with your taxes timely. This is why so many people resort to an offer compromise or other resolution to help get them out of the mess and out of these problems. So these are definitely not the only penalties and interest the IRS can charge, but these are the major ones. These are the ones that you get hit with the most. Um, you want to avoid any kind of tax evasion or trying to hide the ball from the IRS or hiding of assets, because the penalties for those are very bad. I want to talk about one last thing before the break, if we could. So foreign assets is a big thing the IRS has been going after for really the last 15, 20 years. If you have any accounts with more than $10,000 on them overseas, it's just a reporting requirement. You just have to put it on your tax return, and CPAs are getting more savvy about this, and they have those questions. Do you have any assets in a foreign country? If you're not sure how much is in there, find out. The penalty here is at least 50% of the asset. So this is where they're not going off of income and have taxing your own income. They're going after an asset, 50% of the asset. And if the IRS finds you or starts investigating you before you report this and get this squared away, there's criminal penalties as well. But as soon as they start looking at it, there's no deal for you. There's no break here. Once they start putting resources to find you, that 50% is the minimum they'll do. So you can try to negotiate it out. You can try working with them. But at that point, you need criminal representation to make sure that you don't end up going to jail. And they usually don't send people to jail because they want the money. They don't care about people going to jail, but they will take these assets, the value of these assets. And if you address it and get ahead of it, you can get away with a 5% penalty, not a 50% penalty. So again, be thorough with your CPA. If you have questions, call a tax attorney and review your situation with them. And just once you're on top of it, it's so much easier to stay on top of it. If a problem happens and you can't keep on top of it, or you can't afford a certain year, there are programs, the hardships program, the installment agreement, and yes, even the offer and compromise if you qualify for it. So we're 20 seconds away from another break, and what we're going to do is talk about how to get rid of different ways to get rid of penalties and interest in this last little bit that we have. So again, Hubert Johnson here with Taxes Made Easy. Give us a call if you have any questions, and we'll be back shortly. Okay, Hubert Johnson back. We talked a lot about penalties and interest and where these nasty penalties come from, how they can just stack and really pile up on somebody. And again, the best way to fight these penalties and interest is to address these one by one. So first of all, file timely. The best way not to have penalties and interest is to get on track. So true story here, had a client owed close to $2 million. And they had a financial advisor that was working with them, managing their finances, helping them out. They had someone that really messed things up, went through a divorce, life went crazy for a while, and he was getting everything figured out, back on track. But in the meantime, he ended up owing $2 million or so. The interest and penalties were, of course, insane. So they were busy paying the oldest tax year first. They thought they would score some points with the IRS if they were paying the oldest tax debt first, and they figured that's what they should do. Problem is, every single year that they filed, they started filing timely, but they were getting smacked with a failure to pay timely, with ongoing interest and penalties on all these new tax debts. So, and if the first couple of years that they were getting squared away, they weren't filing timely right away. So I was like, look, you're doing it backwards. So if you take anything from this, listen to this. Moving forward, you want a clean slate. You want to show the IRS that you're not going to have problems moving forward. They might not like you paying off the newest tax debt first, but that's exactly what you should do, because all those penalties and interest have not accrued or maxed out on your newest tax debt. Now, when I say your newest tax debt, I'm talking about the current tax year. So they were filing taxes, owing again, and getting smacked with all these new penalties every single year. I said, you've got to flip things on its head. Make sure, number one priority, make sure you're paying enough in the current year. Either increase your withholdings, start making estimated tax payments, do something. You've got to change things so that you're not going to owe for the current year. And the beginning of the year is the best time to do it. We're still early in the year, January, February. You can make adjustments, maybe pay a little extra. If you do owe for 1 month, it's not going to kill you at the end of the year to pay that by April 15th of the next year when you file your taxes. So, and here's the funny thing, the IRS, it's part of compliance, filing compliance, payment compliance, two most important things to the IRS. So if you take this money and you pay more in current taxes, you could qualify for a better result. So I was just looking in the case yesterday, where this guy, he was getting killed on taxes, but it looks like what he did is that he got hit with a lock-in letter. We talked about that the other day. But his wife stopped paying taxes altogether. Even with the lock-in letter, he's owing $8,000 a year. New taxes, new liabilities piling onto him. So I said, hold the phone. We've got to stop this. So if he owed $8,000, he should pay another $8,000 for 2024 for the current year. So by increasing his taxes moving forward, now he qualifies for an offer and compromise. We can wipe out all the past due taxes. But if he owes again for 24, 25, 26, he's going to default anything. So we've got to make sure he's not going to owe moving forward. That should be your number one priority. So first of all, paying your current tax year first. Second of all, if you have a choice, pay on the next oldest or the next newest tax return. So right now, if you're going to owe for 23, but you have a chunk of money, make sure you're caught up for 24, pay off 23 before April 15th. We saved them hundreds of thousands of dollars on this large case by changing how they were doing things. And when we talked to the revenue officer on the case, he said, well, yeah, of course I want more paid on the past due taxes, but your representative is absolutely right. Making sure you're filing compliant and payment compliant for the current tax year. So filing compliance goes back 6 years. Payment compliance has to do with the current tax year. Then you can get a resolution. They can talk about it. You can't even talk about getting a resolution in most cases until you're paying for the current year taxes. And just changing how you're doing things will save you a lot of money and a lot of heartache going forward. We were able to set up an installment agreement on the past due taxes, and I have cases right now. Someone else owes well more than $1 million, and you don't have to owe $1 million for this to really help you out. People can owe $10,000, $20,000, whatever. And making these changes can absolutely save you money in the long run. And that's what we want to do, is put you in the driver's seat in the long run to save money and avoid paying taxes. We want to avoid the stress, avoid paying as much as possible in taxes while keeping you current with your tax obligations as a citizen. So making sure you're paying your current year first. What do you do about all these past due interest and penalties? There are two programs that are called abatements that you can ask for. So to abate is to get rid of or remove. So an abatement is you're asking the IRS to get rid of penalties and interest that have accrued. And do they get rid of all the penalties and interest? No. But you can get rid of the failure to file, failure to pay, and the interest that is accrued off of those. So you don't get rid of all of the interest and penalties, but you can get rid of a huge chunk. Depending on how old your tax debt is, you can get a much bigger chunk. So when we first step into a case, that's not the first thing we do is go for a penalty abatement. The reason for it is you want to wait, ideally until you're close to the end of the case. But the best time to do a penalty abatement is when the tax debt is all paid off. We usually don't wait that long though, because people are usually long gone. We've set up their case, it's been resolved, and they're moving on with their lives. And we are too. But that way, if you pay off your balance, then there's no more penalties and interest being accrued, and then you can get the most penalties and interest removed off a case. You can usually only do this once. So that's why waiting until the opportune moment, according to Jack Sparrow, is ideal. So once you get an installment agreement, those penalties and interest aren't as bad. You can get a huge chunk removed by doing what the first option is called a first-time abatement. And this is something most people can just ask for. Now, how this program works, and this is a newer program, the last 8 years or so, that when you ask, you can do it over the phone. Most of the time it's done over the phone. When you call the IRS and you're speaking about your tax debt, you just have to ask for a first-time abatement, and they'll look at the oldest tax year. So if you go back to your oldest tax year, if you didn't have any penalties or interest assessed in the prior 3 years, they will get rid of the penalties and interest. Now, can you get it done on multiple years? Yes, but the IRS doesn't like to do that. And they usually don't know that you can do that. They'll usually tell you, oh, no, you can't do that. But let's say you owed some older tax debt. You owed for 14, 15, 16. You can go to 2014 as long as you didn't have problems in the prior 3 years. And again, it can be a small penalty. I've seen a penalty of just a couple dollars that will that will prevent the abatement. But then you owe again in 21. But prior to 21, the prior 3 years, you didn't have any issues. So it's a way that the IRS rewards taxpayers for having a good filing history. So you go in and you just ask for it. They'll run it through the computer system. If the computer system says no, I usually ask, well, can you tell me why? Are there any issues in the prior 3 years? If there are, it's just a simple yeah or nay. You either qualify or you don't. Either you have the good filing history or you don't. But if they do, they'll remove the penalties right there. And if you've been paying it, you can generate a refund, or it could just lower your overall balance. But it's only one time per year. And so usually what we do is we'll call, and if we're going to go for multiple years, we'll call and ask for penalty abatement, and then we'll call again later on another issue or confirming that the installment agreement or something is set up, and we'll do a penalty abatement on the second year. The second abatement program is called reasonable cause, and this has been around forever. Most states have a reasonable cause abatement. It's not easy. It is subjective. It is fact-based. So I had one client, fell off a horse, had a traumatic brain injury. She got denied on her abatement. She had a brain injury for years, and she couldn't, she didn't have the mental capacity to deal with her taxes. That's a perfect case for an abatement. So why was it denied? Because the abatement process requires that you prove everything up. So substantiation, documents, doctor's notes, she didn't have any of that. And what she did provide was spotty, wasn't conclusive. It didn't provide a full picture. So when they read it, it's like, oh, well, this person's claiming a brain injury. Where's the proof? Where's the doctor notes? She didn't have a good record. And so that's why they denied it. So the technical standard is that it had to be reasonable cause that prevented you from dealing with your tax issues in a certain year. And there's no exhaustive list or certain things. So here are some of the things that can be overwhelming emotionally, that can prevent that can be a good cause for a reasonable cause. Death in the family, immediate family, um, major sickness, cancer. Someone was in the hospital. If you broke a leg and had a cast on for 6 months or 6 weeks, no. They want something that incapacitated you, something that took all your attention, and again, depression, mental illness is a huge reason. Your house burned down, you lost all your records, or a flood came in and destroyed all your records. It happens. And your life was thrown upside down. You couldn't deal with your taxes at that time because everything was, your life just got thrown to the wind. Those are all good reasons. Economic problems, my business was struggling, etc. No, they're not going to take that. And you're stressed out because of poor economy. Again, they're not going to take those kinds of reasons. They really want something that shows that a reasonable person would not been able to focus on their taxes during that year. So on that large case, we were able to show and get an abatement in the couple $1 million case on the first few years, because that's when his wife had died. He went through a series of divorce. He didn't know about the problems hid by a tax preparer. So if you didn't know about the problem and you had people that were supposed to be handling it and that hid the money from you, embezzled, other issues, those are great reasons to get an abatement. But once he knew about the problem and started working on it, they stopped debating. They say, hey, he knew about the problem now. And just didn't make sure it took him time to get his life back in order, to figure things out. But once he knew about it, the IRS had very little compassion for him and refused to abate any further penalties or interest. So again, I've had abatements that I didn't think were going to succeed, but we provide enough proof and substantiation. We were able to convince the person on the other end of this. And these are very long, 9 months to a year and a half on average to get a response, get it considered. You might have to appeal it. But again, most of the time, you're not going to talk to a person. So it's all done by paper, which is the worst way to do things with the IRS. But again, that's just how their abatement process works. States usually have some kind of reasonable cause abatement, but it's harder to get these approved through the states than the IRS. I've had states look at very bad situations and they're like, yeah, we don't care. We don't like to grant these, so no, we don't do it. I've had them do the same thing with offers. So the offer and compromise, and we've talked about that on like this, best way to get rid of penalties and interest and wipe out the debt and give you a clean slate moving forward. So again, the form to do a reasonable cause abatement with the IRS is Form 843. It's a pretty simple form, but the legal arguments that go behind it and understanding the standard of what they will accept and won't accept is what takes the tax experience that we provide or that a tax professional should be able to provide. And substantiation is key. So again, if you have questions about penalties and interest or abatements, give us a call. We're almost out of time here. But again, if you don't know, don't step in a bear trap. Get some help, get some advice before you move forward. So Hubert Johnson, hoping everybody has a great Friday and a great weekend. And again, if you have questions, you can reach out to us through guardiantaxlaw.com or give us a call at 520-485-7371. And we'd love to chat and see how we could help you out as well. So again, thank you for watching us live or on rebroadcast here at smartmoneyculture.tv. And have a great weekend, folks. And prepare for April 15th. Get ahead of it. It's a pain, but save yourself some money. And have a great weekend.